Hello and welcome to BTTV. Home loan interest rates across banks and lending institutions have been at the lowest in 15 years. Property prices have been in reach too. It's a wonderful time to explore options in the real estate market, but investors need to be cautious. Why? We have with us Mr. Raj Khosla, founder and MD of mymoneymantra.com to answer such questions. We also ask him, where does he see home loan interest rates moving on from here? Here's an insightful video. To provide you a hint, Mr. Khosla says it's a good time for home buyers to lock in fixed interest rates in home loans.
Well, actually, the short answer is it is really a good time, to buy property. So it's a perfect time, really, because interest rates across all banks and lending institutions are at the lowest mark in the last 15 years. For example, look at Citibank. Today, the rate is as low as 6.65% per annum. Sounds unreal, doesn't it? But I mean, well, if you asked me even a year ago, will rates be like this? I couldn't have imagined, but yes, but they are. So generally speaking, property prices have remained within reach. That means, they've been subdued. Developers are offering great deals and discounts, to attract customers. So it's an absolutely wonderful time to explore options and to double down on a decision. I might add a word of caution here, ma'am, is that it is a COVID hit market and purchasing property for self-use is a good idea. Speculative activity, not a good idea. The days when property doubled in value in a few years are long gone. So, as things stand, the economy is not in such great shape, and it is impossible to predict when the economy will indeed bounce back. So whenever it is that the economy begins to run, it could be even longer before realty feels an uptake. There is going to be a lag. So essentially, if you can make it happen, bite the bullet and acquire a ready-to-move-in self-use property, whether it's an office, a shop, your dream home, just do it.
And recently we saw SBI Bank and one or two more banks hiking the interest rates on home loans. Why that? And do we see other banks also following this suit?
But well, hiking, as in, I don't know if you can classify that as a hike. You see, State Bank of India was offering special festival schemes on home loans, one of which offered home loans at 6.7%, which expired on 31st March. Secondly, there was a processing fee waiver, which is also part of this festival offer. So yes, there has been a slight increase in the rate. Viewed differently, and possibly with a pinch of salt, you could say that it is actually a withdrawal of a seasonal offer. Certainly, when State Bank of India brings a change in the lending or deposit rates, it is expected that other banks will definitely follow suit. However, I hasten to add that even with the envisaged corrections, rates of around 6.9% are still extremely attractive.
Do you see interest rates by any chance going down further from here?
So my personal view is that there is nothing further left to correct. Rates are down to bare bones. So I don't think there's any correction in terms of pricing of rates of home loan interest around the corner. So unless, of course, there's a totally, wacky event and the economy goes into free fall, I don't see a further fall in interest rates. So all those who are considering a home loan, now is really the best of times. And I would go a step further and say that if you're considering a 15 to 20-year home loan, might be a good idea to lock in a fixed rate home loan. It will, of course, be a little pricier than a floating rate home loan, but rates being so low, good idea to lock in a low rate, over a long period of time.
If you could give us some idea about the balance sheet, how strong the balance sheet is of the big developers, because last few years, if I talk about NCR, investors or property buyers have faced difficulties in getting the ownership of their houses after paying a lot of money. So any idea about the strength of the developers' balance sheets?
In a general way, the bigger names, that is DLF, Godrej, Hiranandani, and a handful of such, did maintain the strength of their balance sheets and continue to build and develop and launch new projects even in these challenging times. Dare I say that even the consumers were much happier to deal with established brands. At the lower end of the developer community, possibly the people you're referring to, things have not been so sanguine, in as much as cash flow problems have actually stymied their progress. In fact, we have seen some of the stronger names actually collaborate with the unfinished projects, and this can be termed as a proverbial win-win. That is for the developers as well as for the customers. Whenever there's a collaboration of an unfinished product with a strong developer. So, that's really today's state, and there is a flight to quality over here, and even in this space.
Would it be better to go for ready to move in projects right now, or should investors look out for new projects as well?
Actually, it depends on, if you're looking for a ready to move in property, then it doesn't really matter who the developer is. And so you could go in for that. If you're looking for something which is under construction, then quite honestly, it's better to go for an established brand and be sure of your delivery. And that's the way to look at it. In terms of pricing, actually, it will depend from project to project. So you can't really say, which is better or worse. But the essential rule being, under construction, go for a good name. Ready to move in property, you can be more flexible. You can go with anyone.